Hello, everyone, and thank you for attending today's webinar, Employee Benefits in the Time of COVID-19. What should employers know? My name is Lisa Tavares. I'm one of the employee benefit lawyers here at Venable, and I'm joined today by my colleagues Harry Atlas, Tora Johnson, and Juliana Reno. This is a very challenging time for all of us, both personally and professionally. Many of us are dealing with hard decisions about our workforces in these difficult times, and perhaps caring for people or learning difficult news about friends and family. Today, we want to talk about the impact of current conditions and recent legislation on both retirement plans and health plans, and we'll also talk about some changes to executive compensation. I want to make one note that in this new world, this is the first time I've done a remote webinar. I'm sure many of you are working remotely, hopefully staying safe in your respective homes. But in this new environment, there's no telling what we might hear between children I have in my house and other people. So if you be patient with us, we've done a sound check. We think everything should go smoothly, but there might be human elements that change our usual webinar scenario. If you have any questions during the webcast, you can submit them through the Q&A widget on your screen. And we also want to note that the recording and the corresponding PowerPoint slides that you'll see today will be available for download early next week. So again, thank you for joining us. We're going to move on to discussing legislative and regulatory updates. And the first set of changes I'd like to talk about are retirement plans. There are changes to both distributions and loans. The Coronavirus Aid, Relief, and Economic Security Act that was effective March 27th made changes to various retirement plan benefits. The CARES Act itself made two important changes to in-service distributions and loans. With respect to distributions, individuals in a defined contribution plan are permitted to request an in-service distribution now of up to $100,000 for coronavirus-related purposes. Such coronavirus distribution is considered to be coronavirus-related if between January 1st, 2020, the beginning of this year when some people were impacted, before it became a bigger issue in the United States, and the end of this year, December 31st, 2020, an individual is diagnosed with COVID-19 with an approved CDC test, their spouse or dependent is diagnosed, again with the approved test, or that individual experiences adverse financial consequences as a result of a furlough, a layoff, a reduced work schedule, or the inability to work because there's no child care. If these coronavirus-related criteria are met, those people are qualified individuals, and that up to $100,000 coronavirus distribution is not subject to the 10% penalty on premature distributions that otherwise would apply to an in-service distribution. Also, coronavirus distributions are included or will be included in income over a 3-year period to spread out the tax obligation if the participant elects. And interestingly, the coronavirus distribution can be repaid to the plan over a 3-year period in one or more payments. So there are a lot of issues that will have to be sorted out, but we've been talking to many of our clients this week so far about the various opt-ins or opt-outs that various record keepers have presented. I know there's some deadline for some of the large record keepers today. We expect that there will be some more guidance on the distribution elements, more specifics about exactly how all of this works in the coming months from the IRS. But this is what we know for now, and I think in good faith interpretation, a number of the record keepers are putting into the record keeping system as best possible administrative procedures to comply with the statute itself. The last thing I would note on these coronavirus distributions is that the CARES Act allows for employees to self-certify that they will meet the criteria that I mentioned above about a qualified individual who has a coronavirus, is eligible for coronavirus-related distribution. Next, we'll talk about loans. And the CARES Act made a change with respect to the Internal Revenue Code section that normally limits loans to the $50,000, 50%. There's a great expansion here that's temporary to allow a loan to the lesser of $100,000 or 100% of the participant's vested account balance. This change was effective as of the date of the enactment of the CARES Act, which was March 27th, and the increased loan limit can be utilized until September 23rd. And another provision of the CARES Act, any loan repayments that were due between March 27th and the end of this year may now be deferred for 1 year. The 5-year generally applicable loan repayment period, or if you have the extended repayment period for residential loans, is going to automatically be extended for the deferral period if the plan elects to include this option. The loan sections also present a number of questions, and we've seen different responses from various record keepers on how some of these loan issues are going to be handled. But as the coming weeks transpire, we would expect to understand more and more about the impact of the loans. There, in particular, with respect to the repayments, I would expect that that's something that would involve some employer involvement, at least from the various record keepers that I've seen. There has to be someone to track those loans, and certainly that's going to involve payroll and other functions that have to ensure that the loans can be record kept correctly and that data sent to your respective record keeper. Now I'll turn it over to Harry to talk about other CARES Act changes applicable to retirement plans.
Thank you, Lisa. The next topic, it relates to required minimum distributions. And unlike the items that Lisa mentioned, this applies to everybody, whether or not they're directly affected by the coronavirus in the manner that Lisa described. And so this relates to individuals who were subject to the required minimum distribution rules in 2020. And that can be somebody who is already taking their required minimum distributions, or somebody who turned 70 and a half last year and is now required to take their first minimum distribution in 2020. The change is that any required minimum distribution that's otherwise due during 2020 from a defined contribution plan, including the various types of employer plans that are listed on the slide, as well as an IRA, need not be made. The purpose of the provision is to avoid requiring people to take their money out of their accounts while the market is extremely depressed. For beneficiaries who have an inherited account and were planning to take their distributions over the 5-year period following the participant's death, 2020 does not count toward the 5-year period. So they essentially can skip the 2020 distribution and tack on another year at the end of the period. And then finally, if somebody who's required to take a minimum distribution chooses to make a withdrawal from their account, the portion of the withdrawal that would otherwise have been treated as a minimum distribution retains its treatment in that it's not eligible for rollover, and it's not subject to the 20% mandatory federal income tax withholding.
Hey, Harry, this is Tora. So it sounds like the changes that Lisa was discussing would allow participants to take money out of the plan more freely, but the requirement here or the the change with regard to required minimum distribution seems to be protective of participants who have experienced, as we all have, the market downturn. Is there anything prohibiting a plan sponsor from both allowing the COVID-19 distributions and putting off and waiving the required minimum distributions?
No, there's nothing would prohibit that. A plan sponsor is permitted to apply each of them. And yes, the in-service distribution and loan provisions are aimed primarily at people who are accumulating in the accumulation phase and likely to be more in need of current cash, whereas the required minimum distribution rules are more aimed at people who have accumulated assets and wish to avoid depleting them. So while they do point in different directions, they are aimed at different issues, and they both apply simultaneously. The next topic that I wanted to, the next topic that I would like to mention is, and this is of great interest for anybody who has a defined benefit plan, and specifically a single employer defined benefit plan. Plan sponsors are very, very well aware that there are required minimum contribution rules under which their sponsors are required to contribute specific amounts on a specific schedule based on the funded status of their plan. The CARES Act says that any required minimum contributions that are otherwise due during 2020 can be deferred until January 1st, 2021. Many companies have a quarterly contribution that would be due April 15th of 2020. That's probably the next one that's looming for most companies. So that quarterly contribution, as well as any other scheduled 2020 minimum required contributions, can be deferred, and that can be very helpful for employers who need that relief. The other provision in the CARES Act for single employer plans relates to benefit restrictions. Under existing law, there are various restrictions on benefit accruals and lump sum distributions for plans that are in endangered funding status as defined by the law. The CARES Act says that a single employer defined benefit plan may elect to use the plan's status for 2019 also for 2020. So what that means is that if a plan's funding status has declined significantly for 2020, if the plan sponsor wishes to, it could potentially avoid the benefit restrictions by using the 2019 measurements. One additional provision of the CARES Act which relates to executive compensation. And this specifically is for a company which avails itself of the loans and guarantees under the provisions of the CARE Act that relate to the $500 billion set aside under Section 4003B of the CARES Act. This is not people who avail themselves of the Paycheck Protection Program. And these executive compensation limits limit compensation payable to officers and employees for the duration of the loan plus 1 year. And there are two limitations. The first is that any officer or employee who receives more than $425,000 in 2019 is prohibited essentially from getting a raise, and also is prohibited from receiving severance or other sort of termination benefits that exceed twice their 2019 compensation. The other limitation for very highly paid employees, if somebody had received more than $3 million in pay in 2019, they actually have to suffer a reduction, and the reduced amount is equal to $3 billion plus half of the excess over $3 billion. And with that, I will turn it over to Juliana and Tora.
Great. This is Tora. Oh, go ahead, Lisa.
I just saw a question, and I want to know if we want to address that. It was a question about the qualifying individuals, stating there's a large number of presumptive positive individuals who could not qualify for testing but were required to be quarantined. And that's true. The statute specifically refers to that CDC test. There are actually other tests, as I understand it, out there. So that's a gap. But the other provision, I think, of the COVID-19 qualified individuals that people may qualify for if they didn't actually have that CDC test is if they are impacted by severe financial consequences related to reduction in work or those other elements that I described. Otherwise, in the current law, it does not appear that they would be eligible for the COVID-19 special distribution. I would posit that might change over time, but I think that's the answer for now. Thanks.
Now turning to health and welfare. And the very first thing we want to discuss is that there is now a requirement for health plans to cover COVID-19 testing. And it's all health plans, fully insured, self-insured, group and individual market, grandfathered and non-grandfathered. And what does it mean to provide coverage for COVID-19 testing? It's not only the test, but it's any item or service that relates to the administration of the test and the evaluation of the person to determine if they need the COVID-19 test, and that actually results in the ordering or administration of that test. So what I'm trying to say here is that it's not only the test itself, and that test can be performed in any setting. So it's your primary healthcare office visit, whether that's an in-person or a telehealth, and they order you to go get the test. In the urgent care setting, an emergency room setting, it's the test, and then it's presumably the physician's fee. And I think it's broad enough to mean that anything the doctor does along the way before the test is actually administered or ordered. So if first the physician says you need the flu test, that flu test would also need to be provided with no cost sharing. And when we say no cost sharing, it means it's provided before deductibles are satisfied. There's no copay. There's no co-insurance. And in thinking about this also, while the physician can say the first thing we want you to do is to do the flu test to rule out that it's not the flu, the plan can't. So there's a prohibition on medical management and prior authorization. So the treating physician can decide what's appropriate along the way, but the plan can't mandate flu test first. And then when we talk about the cost to the plan, what is it that the plan has to pay? If it's an in-network provider, then it's the negotiated rate. If it's out-of-network, then it's the cash price as listed by the provider on its website. And actually, HHS has authority to levy civil monetary penalties and corrective action plans if providers don't have their cash price on their website. I think every smart provider is going to list their price, and it's relatively cold comfort to a health plan because there's nothing built in to protect the plan from excessive charges. The only requirement at the moment is that that price be on the provider's website. Juliana, did you want to talk a little bit about COVID-19 and preventive care?
Sure, thanks. So I think it'll be helpful here if we start by saying that all of these plans most of these plans are required to provide preventive care with no cost sharing already. The normal rule, the rule that's already in place, is that preventive care is an item, service, or immunization that is on one of 4 lists. And the plan has, once an item shows up on one of those lists, the plan has at least a year to start covering that. That's the general rule. This is just creating a special rule for COVID-19 preventive care. So if there is an item, service, or immunization intended to prevent or mitigate COVID-19, that's the scope of the preventive care that we're talking about, it has to be covered within 15 business days after it appears on that list. Okay, so you don't have the 1 year anymore. You just have 15 business days. Now, right now, there's nothing listed. Okay, so the 2 lists that you'll have to keep an eye out for, or your TPA or insurance company will have to keep an eye out for, are, again, 2 of the 4 lists that were already there. One is the U.S. Preventive Services Task Force recommendation A or B, again, same standard that we've had. And the other list is immunizations recommended by the Advisory Committee on Immunization Practices. That's out of the CDC. So COVID preventive care has to be covered, no cost sharing, like Tora said, no deductible, no copay, no coinsurance, within 15 business days. The statute, the CARES Act, was not specific, not super specific about whether, well, let me say, normally preventive care, the plan has to cover preventive care at 100%, no cost sharing, in network. It does not have to cover it that way out of network. We think that the COVID preventive care follows that same model. If you're going to have to provide it, you're going to have to provide it in network, not out of network. Seems to be what the statute is saying. I would expect a little clarification, but that's our working assumption. Okay, we're going to move on to the next slide, which is about high deductible health plans, that's what HDHP is, and health savings accounts, that's HSAs. So general rule also has been in place for a long time. In order to be eligible to contribute to an HSA, an individual must be enrolled in a high deductible health plan. There are also other requirements. We're not getting into those. What we're worried about here is what are the rules? So you have to be enrolled in a high deductible health plan, and it has to follow all of those high deductible health plan rules. What are those rules? The big one, the one that's relevant here, is that the high deductible health plan cannot pay for any benefits except preventive care, which we just talked about on the last slide, until the enrollee meets the minimum deductible. And just a little side note here, there's the minimum deductible allowed in the statute, and there's a minimum deductible allowed in the plan. The one that's relevant here is the one in the statute, which it changes every year. It's indexed and things like that. Okay, so the question that this all brought up, that all these COVID, all the stuff on the previous slide, you know, if we provide testing and preventive care before the deductible, is that going to ruin everybody's eligibility to participate in a health savings account? And then I'm going to pass it back to Tora to talk about the answer.
Right, and we got good news there that COVID-19 testing and preventive care will not make a plan fail to satisfy those requirements. It'll still be considered a high deductible health plan that permits participants to contribute to HSAs. And the reason for all of this is it's part of the government's COVID-19 response. You know, it is intentionally removing barriers for testing and treatment. So you can still be a high deductible health plan even though you are providing first dollar coverage for testing and for the preventive care. And what's interesting there is, and what's interesting there is there's no time sensitivity, so it's while we're in the midst of this emergency and forever after. And similarly, they have decided and clarified in the statute that treatment for COVID-19 before the deductible is satisfied doesn't make the plan fail to be a high deductible health plan. So you can provide treatment. Now, you have to do the testing and the preventive care. The paying for the treatment with no cost sharing is a choice. A high deductible health plan doesn't need to do that. And quite frankly, what we are seeing in the marketplace is a big push in the fully insured market to covering the treatment with no cost sharing. And we're seeing a lot of self-insured employers also considering doing that, but weighing certain pros and cons. For instance, if the employer is considered to be part of the critical infrastructure, some employers are looking at what the participant's maximum out-of-pocket is and seeing whether or not it's actually a significant hit to the employer to actually provide the coverage without the cost sharing as an encouragement for their workforce who is still coming into work on a day-to-day basis. And the other thing that the legislation does is it really promotes telehealth, and you can provide telehealth and still be a high deductible health plan, even if the telehealth is without cost sharing prior to the deductible being satisfied. This one is time limited. It's for plan years on or before 12/31/2021. So on or before 12/31/2021, and that means calendar year plans 2020 and 2021 can provide that telehealth. And I should be clear here that telehealth does not need to be limited to COVID-19. It is for any service and also includes mental health and substance use disorder treatment. And CMS has really been quite active in encouraging states to encourage their health insurance companies to provide this coverage. And we've also seen that the other governmental agencies are promoting telehealth. For instance, the Office for Civil Rights, and in particular, the Office for Civil Rights has lessened or decided to exercise enforcement discretion with regard to HIPAA privacy and security for providers of telehealth, not plans, but for providers of telehealth, because they really do see this as part of the response to keep folks safe and secure, and really are promoting telehealth across the board. And with that, we will move on to over-the-counter expenses and whether or not they can be paid from healthcare accounts such as FSAs, HRAs, and HSAs. And so the general rule has been that these types of accounts can pay for medical care that are not otherwise reimbursed by health insurance. But there's been a big exception that they couldn't be used to pay for over-the-counter medical items other than insulin without a provider's prescription. The theory being that you couldn't use these accounts for general health or items of personal purpose. But that, too, has changed with the CARES Act. Juliana, you want to talk about that exception?
Yep, that's me. So what the CARES Act did was it eliminated the exception for over-the-counter items, which means that health FSAs, health reimbursement arrangements, and health savings accounts can now reimburse over-the-counter items that count as medical care. So a bottle of aspirin, your cough syrup, things like that. We have gotten a lot of questions about this, so I want to go through some of them. The first question that we get is about flexible spending accounts. Do we have to amend our flexible spending account plan? The answer, honestly, is that you have to look and see what your plan says. Some plans say, we will reimburse over-the-counter items to the maximum amount allowable by law. If that's what your plan says and you want to cover these items, then you don't have to make a change because it's already there. A lot of other plans say, we'll cover over-the-counter items so long as they're prescribed or so long as they're insulin, otherwise we won't cover them. If your plan says that, you want to cover aspirin, et cetera, then you're going to have to do a plan amendment. So whether or not you have to, first of all, nobody has to cover these things, right? But if you want to, then you have to look at your plan to see whether an amendment is necessary. We've also gotten questions about health savings accounts, whether those have to be amended. By and large, the employer is not in charge of what the health savings account can reimburse. There's a reason for that. The reason is that we don't want those plans to be ERISA plans, because if they were ERISA plans, then the employer would have all kinds of obligations, fiduciary obligations about how the health savings accounts could be invested and things like that. So most employers' contributions to an HSA are designed so that it will not be an ERISA plan, and you, the employer, will not be in charge of what can and cannot be a benefit under the HSA. Last one is health reimbursement arrangements. We've gotten questions about those too. So there are, generally speaking, two different kinds of health reimbursement arrangements. There are standalone HRAs and there are integrated HRAs. Standalone HRAs are mostly prohibited under the Affordable Care Act. The most common ones, though, are for retirees. Those are permitted. For active employees, you're usually going to have an integrated HRA. And what that means is you've got an employee, you offer a major medical plan, and you offer an HRA that you, the employer, fund and with a little money, and the employee can use that money for certain things. Almost always, the employee can use that money to help pay deductibles, co-payments, and co-insurance under the plan, not anything else. That is really 95% of the plans that we see are designed that way. So it doesn't really make any sense to amend your integrated HRA to cover over-the-counter items. You could if you wanted to, but that's not what those accounts were designed to do. So we would generally recommend that you not amend integrated HRAs. If you have a standalone HRA and you want that standalone HRA to cover as many of the allowable expenses as possible, then sure, we can check and see. Again, it depends on the terms of the document as it exists, whether an amendment is needed and whether you want to cover it. Again, you do not have to cover this in any of your plans.
Hey, Juliana, we've gotten a really good question, which is there a time limit on this FSA change? Does it go through 2020 or until further notice?
It is not limited. It is not time limited. It looks like a permanent change.
And then I'm going to bite the bullet and say 3 words that I never thought I would say on a webinar, but we've gotten the question, and it's a good point. Question from the audience as to whether or not this change also permits the reimbursement of feminine hygiene products. And the answer is yes, those are considered medical now and can be reimbursed out of these accounts.
So with that, I think we're going to move. We're going to move on to frequently asked questions, and I think we're going to bounce it back to either Harry or Lisa. I'm not sure who's taking this one.
I'll take it. This is Harry. Thank you, Juliana and Toro. So I'm going to talk about a few recurrent questions that we've received in the context of retirement plans and all the current turmoil. And I'll just preface this by saying that these actions are not anything that any employer wants to do, and we've seen kind of without exception employers are taking these actions, with reluctance and with particular concern about their impact on the lower paid portions of the workforce. That's really been universal. So with that, just to get into a few of these, probably the most commonly asked question in the last week is, can we stop contributing to our retirement plan? And, well, as I mentioned earlier, for the defined benefit plans, the answer is yes by statute. There's no requirement to contribute to a defined benefit plan in a single employer defined benefit plan in 2020. For defined contribution plans, it's a little bit more nuanced, and the answer really is it depends on the type of plan you have, and it depends on the terms of your plan. So the first distinction is do you have a safe harbor plan? Safe harbor plan is a 401k plan or a 403b plan that is designed by design that provides a fairly significant employer contribution, and in exchange for that, the plan does not have to have discrimination testing. And if you have that kind of plan, the rules for mid-year cessation of contributions are pretty cut and dry. First, you have to make sure that you've reserved the right in your annual safe harbor notice to reduce contributions. Pretty much, in my experience, pretty much every big record keeper has that language in the safe harbor notices. So it's pretty unusual that somebody would not have reserved that right in their safe harbor notice. And then beyond that, you have to amend the plan, and you also have to give participants notice. And the cessation of contributions cannot be effective for at least 30 days after the later of those two things has happened. So the later of the date that you amended your plan to cease contributions and the date that you provided the participant notice. And then finally, the plan does become subject to discrimination testing. The non-safe harbor plans are a little bit more varied. And again, the answer depends as to whether you can, whether you can stop contributions in the middle of the year depends on plan terms. And you have to look at the allocation period for employer contributions. Some plans have contribute each payroll period, some contribute quarterly, some contribute annually. If you're contributing each payroll period, it's pretty likely, although there's still some exceptions, but it's pretty likely that you would be able to stop mid-year. If your allocation period is plan year, you have to look at whether the participants have earned the contribution as of the date that you want to stop, as of the date that you want to eliminate the contribution. And whether participants have earned the contribution depends on whether there are conditions that they have not yet satisfied, such as being employed on the last day of a plan year, completion of a certain number of hours of service during a plan year. So the short answer is whether you can stop mid-year depends on the terms of the plan. Often the answer is yes. Oftentimes a plan amendment is needed, but sometimes the answer is no if there's a fixed contribution obligation and participants have already earned the right to the year's contribution. A couple of other considerations that we've seen. The first is if employers are concerned that if they stop their match, employees, and particularly non-highly compensated employees, might turn down their deferral rate, which is pretty likely, and that might impact testing. And another issue that we've encountered is fairly rare nowadays, but there are some plans that have a so-called Social Security integrated contribution, where a higher rate of contribution is provided on compensation that exceeds the Social Security wage base. And those can be a little bit tricky to stop mid-year because you might, depending on how frequently the contribution is made, you might end up with an unusual result.
Hey, Harry, we got a question from the audience about the recommended time frame for advanced participant notice if it's a safe harbor plan. Do you have thoughts on that?
Well, sure. If it's a safe harbor plan, then it's required by law to be at least 30 days. If it's not a safe harbor plan, and if you're otherwise allowed to stop contributions, there's no prescribed advance notice, but certainly you want to give some amount of advance notice as much as possible. Another topic that we've received many questions on, and an unfortunate sign of the times, is the impact of furloughs on retirement plans. And just to be clear definitionally, because it's very important for this discussion, by furlough, we're referring to somebody who remains on the employer's books as an active employee simply without pay. And that's distinguished from somebody whose employment has been terminated. So the questions that we're getting in regard to furloughs are there's a few different varieties of them. One type of question is, well, how does that impact people's eligibility for the plan? And how does it impact their vested status under the plan if we furlough people for, say, 4 months or 6 months or whatever the case might be? And the answer there, again, is it depends. It depends on how the plan credits eligibility and vesting service. Some plans credit eligibility and vesting service based on hours completed in a 12-month period, hours-based plans. And other plans use a so-called elapsed time method, where they look at the amount of time that the participant has been employed without regard to the number of hours that they complete. And some plans use a mix and match. Some plans will use one of those methods for eligibility and a different one for vesting. So the impact of the furlough really depends on the type of service crediting. If you're using an elapsed time method, as long as the furlough is less than 12 months, the participant remains considered to be active and continues to be credited with service. By contrast, if you have an hours-based plan and somebody's furloughed, today, it may interfere with their ability to complete 1,000 hours this year. Depends on how long the furlough lasts. So that gets really tricky. And like I said, these questions have been asked out of concern for employees and a desire to minimize the impact. And one thing to keep in mind with each of the points that we'll talk about on this slide is that it often would be possible to amend the plan to provide more favorable treatment. So if there is a concern about not harming people who are furloughed, it often will be possible to amend the plan in some manner to provide more favorable treatment than otherwise would be provided. Another topic that we've had questions about is what happens in the defined contribution plan in particular if somebody is not getting paid. Can we in effect continue to contribute for them as though they were being paid? And unfortunately for defined contribution plans, the IRS regulations do not recognize the concept of imputed compensation, but rather defined contribution plans have to make contributions based on actual compensation. There are potential workarounds if there were a concern about somebody's compensation drop hurting their contribution. You could potentially amend the plan to provide some additional contribution for those people, but it wouldn't be tied to the lost compensation. And a third and related issue is the satisfaction of allocation conditions. So some plans, in particular those that make contributions annually, will require somebody to be employed on the last day of the plan year, or may require 1,000 hours of service during the plan year, or both. And the impact of the furlough, again, depends with respect to whether somebody is employed on the last day of the plan year. If they're in furlough status on the last day of the plan year, they should be considered employed because they're still an employee just without pay. By contrast, if with respect to an hours requirement, a furlough could adversely impact them. Although, again, as mentioned, presumably the plan could be amended to alter that result. Another topic that we've received questions on relates to a partial plan termination. And just to be clear, because this is a little bit of an arcane terminology, a partial plan termination is a concept that's existed under ERISA for decades. And the concept is that if a plan completely terminates, completely shuts down, there's a requirement to fully vest all participants to ensure that participants are not harmed by the plan termination and don't lose their unvested benefits. The code has its concept of a partial termination, that if an employer in effect shuts down a part of a plan or a significant part of a plan, that the people who are affected by the shutdown have to be treated as fully vested. And the IRS has for years identified a 20% reduction in active participants as sort of the baseline for determining whether there's been a partial termination, which requires people to be vested. And so the question comes up, if we're terminating people, if we're furloughing people, do we have a partial termination? Now, with respect to an outright termination, that's pretty clear cut that if somebody is terminated from employment, they count as far as a partial termination analysis. So if you have a group that's terminated, and if it's a group that approaches 20% of your active plan participants, there does need to be an analysis done as to whether there's a partial termination. With regard to furloughs, it's a little bit more nuanced. It relates to the discussion on the prior slide related to vesting service. And for furloughed employees, you really need to look at whether the employees are losing vesting service. And so that, again, that depends. If you have a plan that uses an elapsed time method of crediting vesting service, as long as the furlough is less than 12 months, they don't lose, they actually get vesting service for the furlough period. So they shouldn't count towards a partial termination analysis. And by contrast, if you're using an hours method and if the furlough lasts long enough, it is possible that people would lose vesting credit for the period of the furlough and potentially could have a partial termination. So that's a flavor of the sort of questions that we've been receiving. With that, I'll turn it back to Tora and Juliana.
Thanks, Harry. This is Juliana. We also have gotten a lot of questions about furloughs. And our questions are, well, we're going to furlough some employees. Do we have to continue benefits while they're on furlough? And can we if we want to? So I have a bullet point on the slide that's an issue that Harry raised, which is, what does a furlough mean? And there is no universally accepted definition of furlough or layoff or leave. So when you're asking your lawyers questions about this, it's extremely helpful if you explain exactly what you mean. So for our purposes today, I'm going to do the same thing that Harry did and say that for our discussion, somebody on furlough is somebody who is on unpaid leave, but they're still on the books as an employee. So we have not terminated them under our normal termination procedures. So whether or not you have to or may continue benefits during furlough, you have to know a lot of pieces to the puzzle. The biggest piece of the puzzle is what your plan says. So for example, most healthcare plans will say something like, you're eligible for the plan if you are regularly scheduled to work at least 30 hours a week. Well, when you furlough someone, they're no longer regularly scheduled to work 30 hours a week. So under the plain terms of the plan, they're going to lose eligibility, right? A lot of life insurance plans say, if you go on unpaid leave, you are covered until the end of the month following the month in which the leave begins. Okay, so those people will be covered on furlough will be covered for a certain period of time, but maybe not for the whole amount of the furlough. Can you change that? You should not change that unilaterally. Mostly you don't have the power to. So to the extent that you have a fully insured plan, you need to talk to the insurance carrier. They are getting a lot of these calls and they are being super helpful. There are reasons for that would probably take us too long to go into, but for example, a lot of health insurance carriers are taking the position that as long as you keep paying the premiums for people on furlough, they are not going to enforce the eligibility requirements for the next 2 months or the next 1 month or until a certain date. there's a lot of help available from the insurance companies. You have to talk to them, though. What about self-insured plans? Self-insured plans you're in charge of, largely, right? You can decide to change the eligibility provision. If you have a self-insured medical plan, though, you shouldn't be doing that without talking to the stop-loss carrier, because if you expand eligibility without the approval of the stop-loss carrier, your stop-loss benefits may not flow to someone who incurs medical expenses who wouldn't otherwise be eligible. So the most important thing is to know what your plans say. There are, of course, overlays for federal law and overlays for state and local law. I want to highlight some state and local laws because I think most people are fairly aware of the federal law issues, like, for example, during FMLA, you have to let someone continue on their medical coverage. Okay, so state and local law, most of those are paid leave laws, paid family leave or paid sick leave. So the question is, okay, I've furloughed somebody, they're still on the books as my employee, I have a local law that says I have to pay sick leave. So they get sick when they're on furlough, do I have to give them that paid sick leave? And the answer is it depends on the state and local law, but that's the kind of thing that is coming up as a question. The reason I have termination on here is because some states would consider a furlough to be a termination for purposes of certain wage payment issues, so be careful about that. Not too many, but some. On the last bullet point, I want to touch on medical coverage. So, excuse me, you've decided to continue, that you want people to be able to continue medical coverage. You need to be clear about whether you are continuing them during active coverage or whether they're on COBRA coverage. Remember that COBRA applies if there is a reduction in hours that causes a loss of eligibility. So if somebody goes on furlough and you don't change the eligibility provisions of your plan, they're probably going to lose eligibility. They're entitled to COBRA at that point. That means a COBRA notice, et cetera, et cetera. Alternatively, let's say you've worked it out with your insurance company during the 2-month furlough, they're not going to lose eligibility. Okay, that means no COBRA for those 2 months. You're just going to keep paying the premium. So I'm not telling you to do it one way or the other. I'm telling you need to be clear about whether you're continuing active coverage or whether you're going to have COBRA coverage, and then what the payment arrangements are going to be. Are you, the employer, going to cover the employee's share during the furlough? Are you going to make them pay it during the furlough when they're not getting any money? Are you going to make them pay you back when they come back to work, if they come back to work? If you're giving them COBRA coverage, are you going to subsidize that COBRA coverage at all? Those are all questions that need to be worked through and discussed. Okay, now I'm tossing it to Tora to handle health and welfare reporting issues for COVID.
Right, so Juliana just talked through furlough issues, but this is the scenario where business is staying open, perhaps it's part of the critical infrastructure, and is worried about employees bringing COVID-19 into the workplace and what can be done and what laws apply. And so we've gotten several questions from employers about whether they can require temperature checks. And it often comes up as a question as to whether or not that's permissible under HIPAA. HIPAA is not applicable here because you're in your employer role, not in your provider or plan role. But there are rules to keep in mind, particularly the ADA. Generally speaking, a temperature check would be deemed a medical exam that you couldn't do, but there's explicit guidance that permits this during the COVID-19 emergency. And quite frankly, can probably go a little bit further and ask, for example, are you taking fever-reducing medication? But be very careful not to go very far astray from the temperature check, such as asking about whether they have any underlying health conditions. But non-medical inquiries, like have you been on a cruise lately, would be permissible and not a problem under the ADA. And if you have an employee that's tested positive for COVID-19, need to keep in mind that that is very confidential information, and the name of the employee should not be disclosed while providing the needed guidance to impacted workforce members, reminding them to follow the CDC guidelines and take whatever measures you need to do in the workplace, but keep the name confidential. And consider whether you have any other reporting requirements. OSHA is not us, but we can refer you to our labor and employment friends, and think about whether you have any CDC reporting requirements. And generally the answer to that is no, but you should also consider State Department of Health reporting requirements as part of your decision-making process. Then switching gears a little bit to 125 questions, and I know we've gotten a few of those along the way, and I think we're going to hit on them now. But you've told everyone to work from home. Is that a qualifying life event or a change of status that would allow them to change their 125 elections? The general answer to that question is no, but we should take a minute here and talk about dependent care. And Juliana, if I'm no longer sending my children to a daycare center because I'm now working from home, would that allow me to change my dependent care election?
It would, but it's not because you're working from home. It's because you no longer have daycare costs. So if your daycare has, this is happening all across the country, daycares are shutting down. So if your children were going to daycare and you're paying for them to go to the daycare center, and the center shuts down and they're now being cared for, say, by a family member at home, you're not allowed to pay them from your dependent care account. So you have reduced child care costs. Even if you are still working, you can change your election. So it's not the work at home piece. As long as your dependent care costs have changed, you can make a change in your dependent care elections. Remember that a lot of plans, though, say that you have to make the change within a certain number of days. So we have seen a lot of employers telling employees, by the way, if your child care costs have changed, make your election. There's no obligation on employers to do that, but if you don't want people to miss the deadline, that's how that would get handled.
The other question we're seeing is the insurance carrier is permitting a new open enrollment window for people who did a less coverage or want to enroll a dependent. And the question is, does that have to happen post-tax, or can it be considered a qualifying event or a change of status, allowing for pre-tax contributions? And there's no clear answer here. Things to consider, perhaps, is it an addition or a significant improvement of a benefit package that would permit you to add on a pre-tax basis? Something happy to discuss, but there's no clear answer to that.
There's also,
yeah, go ahead.
Sorry, there's also an argument on that one. For the new open enrollment, there's also an argument that this open enrollment would be a different period of coverage under an employer plan. So that's another possible argument to raise. But again, as Tora said, no clear answers. I'm going to hit the last item, which is if we amend our flexible spending account to reimburse over-the-counter items, what about changing elections? No clear answer here either. I probably would not recommend allowing a change of elections here. I have a hard time seeing over-the-counter as a significant improvement to a benefit package option. It just seems like it's not going to be a high dollar item for the flexible benefit plan. But, if you're willing to take the risk, that's an option. As long as we're talking about over-the-counter, I want to address one of the questions that got sent in asking for clarification on what I said about over-the-counter and HSAs. What I said was that employers are not in charge of the HSAs, which is true. If there was going to be an amendment to an HSA, it would have to be the vendor. However, the vendors don't generally design HSAs. They just say, here's your account, and it's the account owner who is in charge of determining whether the benefit is payable or not. So you can take money out of your HSA to buy a plasma TV if you want. That it's just going to be a different tax consequence than if you take it out to pay for an operation. Now, some HSA vendors do check because there's different tax treatment and they have to report and things like that. But in my experience, all HSA vendors allow all possible medical expenses to be treated that way. So an HSA vendor does not usually say, oh, this HSA plan only covers XYZ medical expenses, but not PDQ medical expenses. In my experience, they cover all the medical expenses. So there's not really any amendment that's going to be happening. It's over-the-counter stuff will probably just be payable. Okay, I think we have one more question. Part-time employees work measurement period. Oh, yeah. Okay, this is a little bit complicated. I'm going to try and do it. We have 1 minute left. The question is, what happens to the measurement period? So this is for Affordable Care Act purposes. What happens to the measurement period if somebody is furloughed or whatever? So I can't answer that because a lot depends on what. It's so fact dependent. What's your measurement period? What's this? What's that? Let me just say it this way. The measurement period method says if you worked a certain amount of time in, let's just say 2019, that means you're full-time and eligible for benefits in 2020, okay? If they're full-time and eligible for benefits in 2020 under this look-back measurement period theory, and you put them on furlough and they're not eligible, but they're still your employee, that's an ACA penalty risk for you because they're still full-time even if you furloughed them. So be careful with that. That's why everybody is worried and trying to make sure that people on furlough retain their medical benefits, aside from the more obvious reason that they want their employees during this very difficult time to be able to have medical coverage. So whoever asked that question, if you need more, please contact us. It's very, very, very fact dependent. And I think I'm done. Lisa, do you want to take us out?
Well, I think we can have a few more. We try to extend our time, so we have a few more questions. One was with respect to the plan loan issues, and I believe someone wanted to know if there was a deferral of current plan loans, and yes, there is for 1 year, and that extends the period of time on the loan, and that's effective as of March 27th. So participants may come starting to ask whether your respective plans are allowing for the deferral of loan payments. We have a number of other questions, which I know we can't get to all of them, since we have so many people on the phone today. Is there anything else, Harry, that you think we can address quickly on some of the ones from earlier? Are you on mute, Harry?
Would you be able to read some of the earlier questions?
Sure. One other thing I wanted to address, yes, Harry, let me see. One of the questions was if you could elaborate on how the employer's funding balance or surplus factors into the deferral of current year required contributions.
This is for a single employer defined benefit plan. If you have a credit balance, that factors into the calculation of your required minimum contribution, but your actuary has probably already given you the number that is your required minimum contribution. That number takes into account your use of credit balances. So whatever that resulting minimum contribution number is, that amount is you're able to postpone contribution until January 1st of next year.
I've gotten a couple of more, I see a couple more questions about the look
Yes,
back
there are a
and the
few more
affordable.
questions.
A few
Yeah.
more of those.
Go ahead.
Again, it's all very fact dependent, but let me say this. The Affordable Care Act has rules. They say if you don't offer a certain kind of coverage to your full-time employees, then you may have to pay a penalty. And the Affordable Care Act defines full-time employees in a very particular way. Most employer plans do not define their eligible employees exactly the same way the Affordable Care Act does. So you are not required to use the Affordable Care Act rules for full-time employees as your eligibility rules for your plan. Okay, so the impact of a furlough on a medical plan, it could impact the eligibility, and it could impact your full-time status, Affordable Care Act penalty, and it may not impact those in the same way. So that analysis is separate for those, right? If somebody goes on furlough in 2020 and they have no hours of service, right? Furloughed hours are not hours of service, not paid or entitled to payment. So that is going to change their full-time status in the next year for Affordable Care Act purposes. It doesn't mean that they may or may not be eligible under your eligibility rules. So there's a lot of variables moving all at the same time.
Right. Thank you, Juliana. So we're still getting questions coming in. One of the questions about recording, and yes, there will be a recording in a few days, and the slides will be pushed out along with that recording. With respect to other questions we haven't gotten to, we will try to get back to people as soon as possible. Thank you very much for your time today. We certainly hope that everyone and their respective families are safe, and that you can try to find some comfort in having some answers with respect to the law in the days ahead. And be well, everyone.